Ladies and gentlemen, the choice of the theme for this year's lecture, improving availability of credit in the Nigerian real economy, the critical importance of liquidity, could not be more timely than now as we navigate the complexities of our current economic landscape. It's become increasingly evident that ensuring adequate liquidity within the banking system is very fundamental to fostering sustainable economic growth and development. The real economy comprises, of course, the agricultural sector, manufacturing, construction, and indeed the services sector, and as the tangible foundation of the nation's economic activity. These sectors collectively represent the intricate web of goods and services that drive economic growth, create employment opportunities, and of course, enhance the overall standard of living. Despite the significant relevance of the real sector, access to credit for such key sectors compared to what is obtainable in other clients is relatively low. According to the survey report conducted in more than 40 economies and released by Statista, in 2024, nearly 141 trillion US worth of credit have been lent out to the real sector in advanced countries in the second quarter of 2022. The figures were twice as high as the volume of credit to the same sector in emerging markets. It's worth highlighting the notable improvements in liquidity within the Nigerian real sector. According to the data from CIBN, the domestic credit stood at 66.4 trillion naira as at December 2022, showcasing substantial credit extended by financial institutions to the real sector of the economy. This figure experienced a significant surge to 6.1 trillion naira by December 2023, highlighting the tremendous potential for growth and development in the real sector.
Regulation is here to stay. Regulation is difficult, and regulation forces banks to think about ways in which they do business more carefully. And that's really what I want to talk about today. Having said that, it was very kind of the Central Bank of Nigeria to give me some added grist for this speech today with the circular that they published, I think only 2 or 3 weeks ago, effectively notifying all banks in Nigeria that the capital adequacy requirements to maintain a license were going to be very, very significantly increased. Now, the purpose of my talk is not to address how banks are going to be able to deal with that, whether it's through the raising of capital, through mergers, etc. But what it does do, and I've got the paper in front of me here, is emphasize the critical importance of capital. And although the central bank's missive is really about the minimum levels of capital that need to be held by banks in order to have a license and continue in business, it's interesting that right at the start, and I'm looking at the paper here, in paragraph 1 of this circular that the central bank issued towards the end of March, they say that notwithstanding the capital increases, banks are also required to ensure strict compliance with minimum capital adequacy ratios. And that's really the sort of part theme, or the introductory, I'll get rid of these papers now, the introductory part theme of this talk. It's about the fact that banks are now fully regulated, banks are heavily regulated, banks are regulated in the context of the amount of capital that they need to hold, and that capital constrains the amount of business that they can do. As you know, in the world today, in order for a bank to do business, you have to be able to maintain capital for that particular business. And there's a limit to how much business you can do based on the amount of capital you've got. The minimum capital adequacy is 8%, but for many banks, that capital adequacy ratio is higher, and it severely limits the capacity that banks have then to do business. In the good old days before regulation changed, we didn't need to think about this. And frankly, I think banking was a lot more boring in those days because deals didn't have to be structured in a way that addressed this problem. The good news is, and if you're a young banker in the audience today, your job's going to be a lot more interesting in the future, ironically, because you're going to have to deal with these capital adequacy requirements. So although my talk today is primarily about liquidity, it's also about how we maximize the use of liquidity in taking into account capital. And I think, to be fair, and forgive me, I'm not trying to offend anyone here, when the central bank here say that the capital adequacy requirements will require banks to increase the amount of capital that they hold if they need to do that to satisfy the capital adequacy ratio, I think that's not strictly correct. If banks don't do anything else and they look to increase their lending activities and they breach their ratios, then of course one of the ways in which they can continue to do business is by increasing the amount of capital they hold. But that's not easy in today's world. I mean, for the banks in Nigeria to raise the amounts of capital required to satisfy these minimum levels is going to be interesting. I'm sure many of them will do it, and banks will be a lot stronger as a consequence. But throughout the world, it's not typically the way that the capital adequacy rules are addressed. Yes, banks can raise capital, but that's expensive, and it's actually quite difficult sometimes to raise that capital. The alternative to raising capital in order to continue to do business and satisfy these capital adequacy restrictions is to reduce the size of the assets that you have on the balance sheet, to ensure that the assets that you hold, which are effectively eating up the capital that you've got on the balance sheets, is reduced. There are two ways of dealing with this problem.
Essentially, what he's saying is that the banking industry should not be left alone to carry the weight of catalyzing this economy to a $1 trillion economy. By way of general advice, there's been a lot of talk about people investing in crypto or people investing not in crypto and all that. Fundamentally, for me, crypto without underlying assets is a Ponzi scheme. I'm speaking to you as a professional. You have your money. If you want to gamble, gamble. So you know you are gambling. But if you want to invest, a securitized structure as put together today, regulated properly by the Securities and Exchange Commission, looks more like investment rather than gambling, which crypto is. But where does that help us? And since I have only 2 minutes, I'll just leave you with the following statistics. Is the ratio of credit available to the private sector as a percentage of the GDP of the country. So if you look at the liquidity and credit to the private sector is a critical engine for driving the economy, what is the percentage of that to our GDP? So let me start within Africa. Egypt. That percentage is 30.85%, according to the World Bank in year 2022. That's Egypt. South Africa, it's 92.2%. The ratio of credit available, domestic credit, not international debt, domestic credit to the private sector as a percentage of the GDP. So let's move out of Africa. China, it is 185%. So the amount of credit driving the economy, which tells you the level of leverage, is close to 2 times the value of the GDP. For the United States, it's 216%. Who can take a guess what it is for Nigeria? Please remember this. When we talk about the weight of the economy, is all about banks, banks, banks alone. Banks have a critical role, But what the Chartered Institute of Bankers has put before us is how to bring other participants to driving this economy. The percentage for Nigeria as at 2022 is 14%.
Over the years, we've always concentrated on the supply side of credit, availability. At independence, we felt we needed money for the private sector. So the Nigerian government and the World Bank established the Nigerian Industrial Development Bank in 1964. The criticism was that Nigerians were not able to access NIDB's facilities because NIDB was driven by World Bank processes and procedures. Oh, let's establish another institution, MBCI, Nigerian Bank for Commerce and Industry, in the early 70s. Oh, MBCI wasn't providing solution. Let's establish NAFOND in 1989. All these are supply side. But nobody was talking about the demand side. What is the absorptive capacity of the Nigerian economy for credit? And that speaks to Patrick's statistics. 14% of GDP. What are the factors that drive investments? If the Chinese are doing what they are doing, and the Americans are doing what they are doing, it's a whole of society approach. And Professor Jibola addressed it too. Credit culture. We have issues. AMCON. What gave rise to AMCON? What is the attitude of, I'm sorry, I'm not, this is time for us to speak the truth to ourselves. What is the attitude of the average Nigerian to credit? In my years at the Bank of Industry, NIDB, BO, almost 30 years, out of every 10 customers who comes to the bank, 8 are thinking of how not to pay back that loan. Yes, how not to pay back. Is that the culture in China? Is that the culture in America? No. So you find out that when you're going through your deal flow, because at the end of the day, what the quality of risk assets will look like starts with the deal flow generation. The character, the quality of the customers. So, whether we're talking of primary market or secondary market, the bottom line is that the risk assets must perform. When you perform as a primary lender, you offload at the secondary market, it gives you more liquidity to go and reinvest, provided those investments will perform. Because if they don't perform, the lender will be out of business. So please, I want us to also pay a lot of attention to ability to absorb credit.
And one has been banking long enough to remember. It was like a mirage, something that was impossible. And a few people came up with thoughts, just like Prof has done, about how to create discount houses in Nigeria. As at that time, it was new. And thoughts were put together. It is on record that Ghana was already practicing it. We didn't have it in Nigeria. But within 5 years, in fact 3 years of involving this, Nigeria was doing better than Ghana. Now, that makes me to feel that what is being introduced, I can foresee that within the next few years, if properly implemented, it's going to improve liquidity in Nigeria banking.